Well, hello, everyone. My name is Lou Johnson. I'm an investment analyst with AI Insight, where I manage our research efforts for alternative mutual funds. COVID-19 crisis has certainly spotlighted the value of a diversified portfolio. One of the tools that can help advisors achieve this are alternative mutual funds, and thus we're going to discuss how these funds held up in 2020 when needed most, as observed across our coverage universe. So let us begin by talking about performance overall, beginning with Q1, which comprised the equity sell-off. All strategies outperformed the S&P, protecting on the downside. Moving into Q2, performance was a different story as the S&P rallied more than 20%, its strongest single quarter return since 1998, leading all strategies to underperform equities. And this is to be expected, though, as a strong equity rally is consistently a challenging environment for hedge fund-oriented strategies. However, if we expand the return period to include the preservation that was achieved in Q1, we see that the majority of strategies outperformed equity markets through the first half of the year. All right, so let's dive into a few of the individual strategies to better understand what worked versus what did not. Beginning with multi-alternative, we observed that multi-manager funds have delivered positive returns this year, outpacing their single manager counterparts by roughly 600 basis points. Furthermore, the sub-strategy has been far more consistent, with dispersion between top and bottom funds of 11% compared to 35% for the single manager structure. The added diversification of the multi-manager funds may have led to these better returns amidst the volatility we experienced here in 2020. Another additive strategy in 2020 has been managed futures. Sharp price reversals can be challenging for the space. However, many managers today have increased their weightings toward short-term trading strategies to better capture these downward price swings. This is often referred to in the industry as crisis alpha. Arbitrage, which includes your merger arb, your convertible arb, among other event-driven strategies, has been another additive fund group in 2020, returning 2.5% with a low dispersion of 8% between top and bottom funds. This is compared to traditional equity market neutral, which returned negative 8.1% through August. All right, so on to what has struggled in 2020. Equity long short overall has returned negative 3% through August, with performance dispersion of 36%. This is relative to the S&P's positive 9.6% return over the same time frame. And what we're seeing is just a continuation of the trends that have been well documented. The value tilt of these strategies, as well as the small cap and foreign market exposures, just really creating a drag on returns amidst the growth-dominated environment we have found ourselves in the past few years. Alternative credit has been another strategy that has struggled in 2020, at least from a comparison standpoint to traditional fixed income. The space has been flat through August, largely influenced by a roughly 10% decline during the month of March. It's difficult to say what one or a few things led to challenges for the space, as the strategy is quite diverse. However, it goes without saying that we have had an unprecedented amount of monetary stimulus since March, with lowered rates, direct lending, and open market purchases by the Fed that may be negatively impacting active managers. Looking forward, uncertainty is likely to remain as we move towards the presidential election and continue to wrestle with the global pandemic. And thus, if you are considering alternative mutual funds as a tool for diversification, it is important to understand they do represent a very broad asset class, a very diverse asset class. And so across our universe, what we're seeing, generally speaking, designed for reducing equity market risk, as such serving as more of an equity substitute, are the equity long short and equity option strategies for hedging against rising rates and for seeking an uncorrelated source of total return. These are what alternative credit funds are typically designed to deliver. Then you have your managed futures, global macro, equity market neutral. These absolute return oriented strategies are designed to reduce overall portfolio risk and thus can be used as either an equity or bond substitute. And lastly, this is similar for the multi-alternative funds, which may represent a one-stop shop for those looking for a single allocation within their portfolios. Important to note that the above, the descriptions I just mentioned, they are speaking in generality. So as always with any complex product, thorough due diligence is incredibly important to understand the ins and outs of portfolio design, as each fund is designed to perform differently across market cycles. Well, to learn more about the alternative strategy mutual funds we discussed today, please feel free to visit our website at aiinsight.com. Otherwise, I just want to say thanks for taking the time to listen to this video.